This is a download from BFM 89.9, the business station.
Good morning, George. The banks in the U.S. reported quite poor earnings for the fourth quarters. We see the likes of Bank of America, Citigroup, JP Morgan reporting quite sharp falls in fourth quarter earnings. What is your outlook for the next few quarters for the banking sector?
We are somewhat negative and cautious about the banks overall. In addition to the banks you mentioned, we're very cautious on Wells Fargo and Bank of Hawaii. There's a SPDR ETF that covers the regional banks here, KRF. We're negative on that. One of the areas that the banks are having an unusual problem is trading, and we've been following that very carefully because the banks have been very much involved with the volume. The VIX index, which is our measurement of volatility, usually is inverse to stocks, but both went up this year. Now, if you really look at it, the VIX went up because of the last 3 days. We had consecutive lows at the end of 2014, but for the rest of the year, it was below average. It was below 15. So there just wasn't the volatility, and the volatility was what traders are calling bad volatility as opposed to good volatility. The volatility last year was really unexpected. It was caused by events and reaction to events that were not expected. Russia, the price of oil, and we start off this year with the Swiss bank no longer supporting the peg to the Swiss franc to the euro dollar. So we're having surprises that are not expected, and from a political point, we're having reactions to news that are not expected. So trading has been quite a concern for banks. And, of course, they have the Dodd-Frank rule that's coming up, and that's going to be very, very hard to follow.
How did we come to this stage, Dodge, that trading income is overpowering lending activity, which the banks are supposed to be involved in? Are they going to be able to increase their lending activity to offset the very poor trading gains, especially in the background that the U.S. economy is actually doing very well?
Yes, now that's the key. The U.S. economy is doing very well. It's doing relatively better than other parts of the world. So, yes, I suspect the banks will start to find opportunities to lend as they see revenues increase from the corporate level. But and low interest rates eventually this year are going to start to go up, and that will be a much healthier economic cycle for the U.S. at least. So I suspect that lending will start to increase as the opportunities become more observable and more assured from the bank's point of view. But still, the banks are they're going to have a difficult time getting through this regulatory maze that they have to go through. It's adding a lot of cost and a lot of regulation to what they do. And we suspect that one bright spot, we're hoping that as we get further into the year, trading becomes more positive, more of a potential for the banking industry to start to earn some more profits. That's going to be the main concern. Will they be able to increase their earnings in this regulatory environment?
Talking about trading gains, there's also the Volcker rule, which is supposed to separate a bank's trading activity and lending activity. Will the banks have problem implementing this?
Yes. If you noticed, the Senate, there is a passing of a rule that will, the House of Representatives, has defied the veto that President Obama has threatened this past Wednesday by voting to approve a 2-year delay in some of the parts of the Volcker Rule. So, first of all, the Volcker Rule is not clear. I mean, it started off as a paragraph, Julian, and then ended up in over 100 pages of regulation. And both houses, both the House of Representatives and our Senate, have agreed that there are parts that have unintended consequences that have to be corrected. So part of it, Julian, is that the Volcker Rule does prohibit banks from trading for their own profit and limits ownership of risky investments. What the House is passing now is going to allow another 2-year delay in the implementation, and it should go through from a just pure rational point of view, because it does. If the banks are forced to sell some of the assets they have, they'll be taking real losses. Yes, 2 years is the fact that it would go from 2 to 4 years does allow the banks further ability to manage its loss prevention and also to sell assets. But even if it does go through, the Volcker rule and all the parts of banking regulation have added a whole level of regulatory prevention, which is good longer term, but shorter term it does create an awful lot of expense that the banks are going to have to bear, and also the price of banks are going to have to bear.
And talking about regulation, President Obama is also planning to tax the rich. Raising about he hopes to raise about $320 billion through things like the capital gains taxes and dividend taxes, as well as inheritance taxes. Will we see an immediate benefit for the economy during the redistribution of money from the rich to the middle classes?
I don't think so. I think there are parts of what he's recommending that are good. The fact that it will help the middle class is definitely a positive. But I think it's going to be over the much longer term, and it is definitely not going to create the jobs that Obama is in his discussion. He's going to be mentioning it in his State of the Union speech on Tuesday. But he is in one of the big arguments is that it's going to create jobs. Well, in reality, the only jobs it's going to create are with the IRS. It really doesn't help growth of U.S. industry. What I'm seeing now is what the Republicans are beginning to coalesce with and get some of the Democrats behind is to have a real reorganization of the tax code and try to eliminate all the different loopholes, some of which will be what Obama is talking about, but not replacing them with other regulatory requirements that require the IRS to do further monitoring. So growth longer term, as the middle class keeps more of the dollars it earns, yes, I think that it won't be short term, but I think over long term that will help, but not at the cost of all the additional regulatory requirements that this is going to entail. I think there is a way of achieving the same thing, and I think the Republicans are on the right track, but they probably don't have the full answer. It's going to have to be both the Democrats and Republicans, so it's going to go through a full tax code and come up with less provisions, less exceptions to the rule.
Will this impact the sentiment in the stock markets because we're going to have capital gains taxes as well as dividend taxes? Also, the banks are going to be taxed on the amount of assets that they're going to have.
Julian, I think the banks are going to go through a tough period, and that's one of the reasons why we're very cautious on banks and are looking to reduce some of our positions in them. As far as the individual is concerned, as far as the stock market is concerned, it's going to take time for all this to go through. Those who are involved with the stock market tend to be very sensitive to changes in the tax code and do adjust their strategies. I suspect that there will be less of a differentiation between long-term and short-term capital gains. So the impact will not be as much on the stock market per se as on the individuals who are involved with the stock market and the tax consequences of what they do. I suspect that the overriding move for the stock market will be economic growth or lack of, and I see that the U.S. economy is growing and we're on the right track now. So and we're also converting from low interest rates to interest rates more tied to what's happening with economic growth. I think the transition may be extended now, and that might make it for a smoother transition. But I think overall, the benefits of tax regulation will be far outweighed by economic progress.
And talking about prices coming off, one commodity that has sunk to a 5-year low is copper. Is this reflective of the poor global economic health, do you think, Dodge?
Well, I think it is reflective more of China per se, but I think there are other parts of it that are creating this problem. Cheaper energy costs in general will encourage mining companies to increase production, and the decline in oil certainly will help costs to produce and transport metals to go down. So that will be helpful for copper. But copper is already seen as being in a surplus in demand. I mean, China in particular, which represents about 40% of the world's copper consumption, it's used in construction, electronics, both are heavily tied to China's property market. Demand for China is not on the upswing. It's moderating. You look at China's Purchasing Managers Index, which was released a couple days ago, last Thursday. It fell for the third month to 50.01 in December, and that was the lowest for all of 2014. Their manufacturing sector, especially those industries related to China's property market, are still struggling due to sluggish domestic demand. And I believe there is a scandal in one of the Chinese ports that have halted the use of copper as collateral to raise finance from banks, and that nearly a third of all Chinese copper imports have been used for financing deals. So that is one of the headwinds that the price of copper and copper as a commodity are facing. But there are also several other headwinds. I mean, commodities normally fall when the dollar rises and copper's price against the U.S. dollar, and the U.S. dollar has been rising, so that's certainly a headwind. And then in addition, the copper market expects a surplus of metal from mines worldwide. So it's not just one, but it's a combination now that we're going to have to work through, and ultimately it will take time for copper to regain some of the momentum to the upside.
Thank you. That was George Dolan, Chairman and Chief Investment Officer for Lander and Fused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.